Okay, well, thank you for coming to the last lecture. Once again, I'm sorry again about having to move the time. I have a good excuse, which is my co-author, Simon Johnson, won the Nobel Prize and has invited me to come to the celebration in Stockholm. So I'm flying out tonight to Stockholm to go to the Nobel Prize celebration. So I'm sorry it comes out of your hide, but I couldn't pass that up. So anyway, so that's why we're doing this today. Reminder: the final review will be in class, normal class time on Monday. So we're talking about chapter 25, and we're talking about sort of wrapping up all our lessons on taxes. And in particular, the motivation for the chapter is why we might want a flatter, simpler tax code. And we talked about three reasons. The first reason is evasion, that a flatter tax code with fewer opportunities for evasion, with fewer loopholes and things like that, will make it harder to evade taxes. The second was simplicity, which is people like filing simpler tax forms, although that comes with costs. And the third is efficiency. And this was highlighting, we ended with last time, was highlighting that the more that essentially the total effect on tax revenue, of tax on tax revenues, is really the central parameter for thinking about the efficiencies of taxation, is essentially the elasticity of the tax base with respect to the tax rate is essentially the key parameter for thinking about the efficiency of taxation. There's lots of things that go into that, which is labor supply effects and savings effects and things like that. But the key elasticity is elasticity of the tax base with respect to the tax rate. So what do we know about that? What do we know about that key parameter? Actually, we've learned some very interesting things. The literature which sort of grew up in the last 25 years, which is focused on this key parameter. We know some interesting things. First of all, we know that overall, the elasticity of the tax base with respect to the tax rate is about minus 0.4. That is, for every 10% you raise taxes, revenues go up by, for every 10% you raise the tax rate, revenues go up by about 6%. Okay? As opposed to if the direct effect would imply 0. So that says there's offsetting indirect effects of raising the tax rate. What do we know about the direct effects? Well, we know a couple of things. First of all, almost none of this is through what you might call the Laffer effect. Almost none of this is through people working less, harder, saving less. Okay? It instead comes from the other indirect effects of things like people taking more tax breaks, changing how they report their income, and cheating. So that's the first thing we know, is that there is an elastic tax base, but almost all of it is from what we call sort of non-economic responses, or non sort of fundamental economic supply responses, and more sort of recording and things like that. The second thing we know is the elasticity of the tax base with respect to the tax rate is basically 0 for the non-rich. That basically for people who aren't rich, there is not much effect of changing the tax rate on their reported taxable income. Once again, not surprising, there's not a lot of opportunities for doing much. If you're a regular working stiff and all your income's withheld, there's not a lot of games you can play. So that's the second thing we know. The third thing we know is the tax base is fairly elastic for the wealthiest taxpayers. That when you raise the tax rate, for the wealthiest taxpayers, this elasticity is more like around, best estimates around maybe minus 0.7 or 8. Okay? That basically the richest taxpayers are very responsive in what they report as income with respect to the tax rate. Once again, it doesn't appear that they're working less, harder, saving less. It's that they're doing various things to lower their tax burden, like changing how they're compensated, cheating, things like that. So that sort of leaves us with a couple of lessons. The other thing the rich do, actually, the super rich do, and there's a fun literature on this, is they move. So there's a large literature on the mobility of the super rich. There's articles looking at top-paid soccer players and top-paid executives, especially in Europe, that if a European country raises top tax rate, they move to another country. So that's another way. Once again, something that like a rich person can do that a regular Joe isn't going to move the country because the tax rate changed. But a rich person's a big enough incentive that they can change their residency. So basically, there's lots of responses. Where does this sort of leave us? Well, basically what it says is there is once again, it's a strong economic pressure towards a broader, flatter tax system. That basically steeper tax systems, which have more loopholes and more rates and things like that, tend to leave opportunities for evasion. They make the tax system complicated, and they have efficiency losses. Remember, we talked about in Chapter 20, progressive taxation has large efficiency losses because of the progressive taxation has large efficiency losses because of the deadweight loss at the top. Now, of course, pushing against all this is progressivity. Yes, it's less efficient to tax the rich, but it also it's also more vertically equitable. And in fact, as I said, the only time I've ever gotten praise in the Wall Street Journal in my life was I wrote an article with a very famous economist named Manuel Saez, who was a student of mine here at MIT. And what we did was we highlighted, look, you can sort of have your cake and eat it too. If you have a system that has modestly progressive tax rates, but a large rebate. So we proposed something where essentially tax rates were pretty flat, but that there was a large rebate to the poor out of that tax system. So yes, the super rich didn't pay much higher rates than the medium rich, but the poor were very protected. And the Wall Street Journal, of course, loved that because the super rich are paying less taxes. I think that Emmanuel has then gone on to be he's changed his tune a little bit. He has gone on to be one of the leading advocates for very aggressive taxation of the rich. He's gone on to have an incredible career documenting how wealth has been concentrated in the hands of the wealthy and arguing that for political as well as economic reasons, we do want to tax the rich more highly. But this is kind of where that sort of logic comes from. And I would say there's a broad economic consensus that the tax system we had in 1986, 3 rates, broad tax base, no different rate for capital gains, you couldn't really take as many tax breaks, was preferred to what we have today. So why don't we have that? Well, there's 2 reasons, political and economic. The political is pretty straightforward, which is that basically it is easier to do policy if you call it a tax break than if you call it a spending increase. And this is showed vividly in 1992 when Bill Clinton was elected. He promised that there'd be massive investments. He ran, it was putting people first was his campaign. That was going to involve massive investments in education, in local infrastructure, et cetera. And as soon as he tried to put those in, he realized that it was very hard to increase spending at the federal level at that point because people were sort of saying, well, that's what Democrats do. They're big spending Democrats. They're going to do that. But as soon as he said, no, instead of spending on education, I'm going to have a tax cut for education, well, everyone loved that because it's free. It's a tax cut. And basically the point is that I showed you last time the tax expenditures, the holes in our tax code because of tax breaks. Well, that's not in the official government budget statistics. Government statistics in terms of what we spend and what we tax. And so people were like, look, that's great. Do it as a tax break. I love that. Don't do it as spending. That's big government. So it turns out there's sort of a political asymmetry in how easy it is to get changes done, calling it a tax break versus calling it spending. So that's sort of the politics. The economics is much more interesting. And the economics is real. And this comes back to this concept we talked about in Chapter 18, which is a concept of horizontal equity or fairness across similar people. And this is highlighted because basically when you change taxes, you create critical horizontal inequities. And to see this, let's focus on the concept of tax shelters. What are tax shelters? Tax shelters are activities whose only reason for existence is tax minimization. They are not economically productive, or they're economically inefficient. Let's say it that. They're economically inefficient, but they exist because of tax breaks. So basically, essentially, to turn an example of that, let's think back to the mid-1980s. The golden era of pre the Tax Reform Act of '86 was the golden era of tax shelters. And that was because there was very favorable tax treatment of a number of asset classes. For example, if you invested in real estate, you got rapid depreciation deductions. We had very accelerated depreciation, okay? And you could treat your profits as capital gains, 60% of which were tax exempt. So you could rapidly depreciate and take your profits as capital gains. There was an investment tax credit and other features. And this led to a large rise in tax shelter activities. Okay? By the mid-1980s, more than $10 billion a year was being invested in tax shelters. And one investor, one industry insider estimated that the sector where this was most visible was oil and gas, because there was huge breaks for investing in oil and gas. They estimated that 75% of all investment in independent oil and gas companies came because of tax shelters. So how does this work? Let's imagine a simple example. Imagine that you had let's say someone in 1983 had an income of $250,000, which today sounds like chump change, but was actually pretty rich in 1983. That put you in the top bracket, the top 50%. There was a 50% tax rate was the top rate in 1983. And you'd be at that rate with income $250,000. Now imagine that you wanted to invest $100,000 of that income in an oil venture, which yielded no income, and you sold 1 year later for $90,000. Well, that would be pretty dumb absent taxes, but with taxes, not so dumb. Let's look at the math, and that's on table 25.1. So you invest your $100,000 in an oil venture. You sell it a year later for $90,000. So you've lost $10,000. But at the same time, there was a special tax break, which was a 60% deduction for all investment in oil and gas. So you get to deduct $60,000. An immediate, this was a deduction of your spending in that year. You deduct 60% of your spending. So you get a $60,000 deduction, okay? So that's going to save you $30,000 in taxes at your 50% rate. Moreover, next year, you get to deduct the $10,000 loss you took. That saves you another $5,000. So on net, you make $25,000 by making this investment. So this is an example of how tax shelters can promote economically inefficient investments. And that's what was happening. In fact, my father was very mad when the Tax Reform Act of 1986 passed because he had money in some of these tax shelters. You know, they were totally legal. It was a productive investment opportunity. So what happens? Why is my dad mad? Well, in 1986, they wipe out the tax shelters. They say these tax shelters can't be used anymore. Well, here's the problem. Asset prices had adjusted to the existence of these tax shelters. What that means is that if you had invested in a totally legal activity that was money-making, suddenly you could get screwed. Let's think about that. Let's think about that as a simple example. Imagine that there's 2 apartment buildings for sale in a city. Okay, one is in a low-income neighborhood, and one's in a high-income neighborhood. The building in the low-income neighborhood is worth $100,000, and the building in the high-income neighborhood is worth $200,000. This is a much nicer board. I don't know why. It just feels better to write with chalk on this board. In the high-income neighborhood is worth $200,000. But the government has a special tax break where for every dollar you spend on investing in low-income neighborhoods, they'll give you $1 in tax credit. So if you spend $100K on a building in a low-income neighborhood, the government is going to give you another $100K tax credit. What that means is that these buildings are worth the same. They're both worth $200K. So you invest, Paul buys one, I buy one. We spend our $200K. We each invest in one. Then the next year, the government says we're getting rid of this. What does that do? That screws me. Paul and I had equally valuable assets. But since my asset was due an embodied tax break, when they remove that tax break, I'm screwed through no fault of my own. No one's evading taxes. No one's cheating here. They're just following the rules. And this is an example, a clearest example of what we call a horizontal inequity. That 2 people took the same action because something out of their control end up with very different tax burdens, very different economic implications. And this leads to, this occurs because this leads to what we call a transitional inequity. A transitional inequity, which is basically as you change the tax code, you are screwing people who made investments based on previous rules. And that is that can be very costly for them. Okay? So as a result, realistically, you're not always going to immediately do the right thing. You might want to make adjustments that ease the pain of those who suffer from those transitional equities. Let's be clear, the people who suffer, Paul and I are rich guys. If we're buying this building in 1983, we're rich guys. So the person who's imposed pain on is a rich guy. But nonetheless, so this is where vertical and horizontal inequities can conflict. When they got rid of the Tax Shelters Tax Reform Act of 1986, rich people got screwed. Now some poor people got, screwed's the wrong word, because they had transitional inequity. Some poor people, mostly rich people. So the question is, you're writing the Tax Reform Act of 86, here's your conflict. On the one hand, you don't feel so bad for them because they're rich. On the other hand, you do feel bad for them because it's sort of unfair. They'd made a legal investment and they're getting hit very differently. Yeah?
And this is a transfer from the person who made this investment to the government in this case, right?
Basically, yeah, which essentially you could think of it as if the government's a big spudge, that's basically right. So in some sense, what do you do with that? So what the Tax Reform Act of 86 did is they essentially limited tax shelters but didn't get rid of them. They sort of eased the pain by limiting, by limiting your use of tax shelters, but not getting rid of them. But this is what leads to a common feature that's discussed in a term you might have heard in political economic policy, which is the term grandfathering. Grandfathering is the notion that when you change policy, you exclude those who were previously affected by the policy as a way of trying to deal with horizontal equity. So for example, in Virginia, every Virginian 65 and older received a tax deduction of $12,000. Virginia was in budget trouble, so they wanted to get rid of it. But people went nuts. And so he literally put in a grandfather clause. Get it? Because they're over 65? Where basically he said, okay, anybody who has already turned 65 as of the day of this law, they still get it. It's future people who don't. Now, on the one hand, he cost Virginia $300 million by doing that. $300 million in lost revenues. Revenues that could have been used for highly valuable activities rather than giving money away to often very wealthy 65-year-olds. On the other hand, maybe he wouldn't have passed the law if he hadn't done it. So this is the difficulty we face when we try to actually change government policies to recognize many decisions and things are based on pre-existing policies, and that means that essentially you might want to go slow. Okay? Questions about that? So, big picture where we are at this point is flatter, less loophole-ridden tax codes. Economists like better. We love where we're in Tax Reform Act of 86. We wish we would get back there, but there's political and economic challenges facing us in getting there. Now, that is one way to get to simpler taxation. But there's another way we could get there, which is we could just say, look, why are we taxing income at all? Thomas Hobbes, in his famous treatise Leviathan, said it is fairer to tax people on what they extract from the economy, as roughly measured by their consumption, than to tax on what they produce for the economy, as roughly measured by their income. Why do we tax people who are making money? Why don't we tax people who are spending money? Why don't we, instead of an income tax, have a consumption tax? And there's a number of reasons why moving from an income tax to a consumption tax, think of it as we'll come back to details, but think of it as a national sales tax. Okay? Well, there's a number of reasons why that might be a positive thing to do. The first reason, so what are the sort of pros and cons of a consumption tax? The pros of a consumption tax is first improved capital allocation. Why is that? Well, if you think about an income tax, different kinds of investments are treated differently. Even in Tax Reform Act of 86, capital gains, even though they were no longer tax favored, were still implicitly favored because you weren't taxed till realization. And in general, tax systems generally feel different. There's tax wedges between different kinds of investments that have the same economic return, and that's inefficient. With a consumption tax, that goes away. You invest in whatever the hell you want, we tax you when you consume it. So there's no reason not to make the most productive investment because they're treated the same by the tax code. We're just taxing you what you get out of your investment. You might invest less overall if there's a high consumption tax rate, but there's no reason it would distort your allocation across investment opportunities. So that's one reason we like it. The second reason we like it is it both increases savings and improves horizontal equity in an improvement dimension, in an important dimension, which is the horizontal equity between savers and non-savers. Okay? And to see this, let's go to table 25.2. Oh, first of all, figure 25.5. This shows how little we rely on consumption taxation, how much they do around the world. So 25.5 shows you that in the US, 18% of our tax revenues are raised by consumption taxes. The OECD average is almost twice that, at 32%. Okay? So basically, and in fact, as you see to the right are more developing countries. In the developing world, most of the revenue comes from consumption taxes. Income taxation is more of a developed world concept. But even in the developed world, we're a relative outlier. Yeah? That's exactly what I'm talking about. I'm going to get there. So basically, why do we like consumption taxes? So one is improve capital allocation. One is because it increased savings and it's fair to savers. So let's go to table 25.2. Consider Homer and Marge. Okay? Imagine Homer and Marge each earn $100 in period one. Okay? And imagine there's a 50% income tax rate. 50% income tax rate. So they each pay $50 in taxes. Homer, being Homer, then eats everything that's left. Marge, being Marge, saves $24.39. Okay, there's a reason I chose that particular weird number. Okay, now in period two, Marge earns $2.44 in interest. Homer earns nothing because Homer didn't save any money. Well, we have an income tax, so her interest is also taxed. She pays $1.22 in tax on her interest. So her period two consumption is equal to her period one consumption at $25.61. So Homer is a full-time period one consumer. Marge is a split your consumption equally person. Okay, so otherwise identical, same income, same animator. Okay, but one person likes eating all their income in the first period, one person likes splitting it. Well, look what happens. The PDV of taxes of Marge is higher. Even though they had the same opportunities going in, because Marge chose to save, she pays more in taxes. Why? What's driving that? What's driving the higher amount of taxes Marge pays in PDV? Not even in PDV. What drives the higher tax she pays? Well, they're both taxed on their income. What's the difference with Marge? Yeah. She's taxed on her interest. Marge is double taxed. Because she's taxed first on the income, she then saves what she earns and is taxed again on the interest on that savings. So there is double taxation in this system. Marge is taxed twice. Homer's only taxed once because he doesn't save. So what this means is that Marge pays more taxes. So now let's replace this with a consumption tax system designed to raise with a consumption tax system. And the way the consumption tax system is going to work, it's going to be 100% tax on consumption. What that means, it's sort of a weird expression. 100% tax sounds crazy. What it means is for every dollar you consume, you pay $1 to the government. Okay, it's sort of a government sharing of consumption expenditures. For every dollar you consume, you pay $1 to the government. Now let's look at these same people. They each earn $100. Homer spends $50 and pays $50 in taxes. Homer's treated the same way he was last time. He doesn't care. Income tax he pays $50, consumption tax he pays $50. Marge, however, saves. She consumes actually a little bit more in period one than she did before, $26.19 instead of $25.61, and saves the rest. She earns interest. Therefore, she consumes more in the second period, but she doesn't pay any tax. She then pays a consumption tax on her consumption. So in the first period, she consumes $26.19, pays $26.19 in consumption taxation. In the second period, she consumes $26.19, pays $26.19 in taxation. I should have said the interest rate here is 10%. So in PDV, her tax burden is the same as Homer's. Okay, because there's a 10% discount rate. So basically, what you see is that under consumption taxation, two things happen. Taxes fall for the saver relative to the consumer, and you have more horizontal equity between savers and consumers. The first system unfairly, in view of horizontal equity, unfairly penalized those who choose to save. The second system does not. So the argument for a consumption tax system is that it will lead to more savings and fair treatment of savers. And indeed, this is the main reason why I think probably the majority of economists would favor replace the income tax with a consumption tax. I know there's a majority, but certainly a healthy minority. I'll talk about multiple reasons. This is the main reason, that basically would improve savings and therefore improve the amount of capital in the economy and improve productivity. Okay? So that's the second main argument for consumption taxation. The third main argument is one that Stephen alluded to, which is simplicity. Enough with 250 pages of instructions and all these form stuff. Just whatever you buy, you pay a tax. It's pretty simple. Okay? It's pretty simple. Okay? Moreover, related to that is so simplicity. So those are the big three pros. So you ask, why do countries have consumption taxes? These are the reasons. Okay? What are the cons? Well, the cons are also pretty strong. The main con, of course, is vertical equity. And that's because you say, well, why is vertical equity changed? They both pay the same consumption tax rate. It's a flat consumption tax of 50% or 100%. Who cares? Vertical equity changes because the rich save and the poor don't. Okay? So the facts are that those in the lowest income quintile in America, the bottom fifth income distribution, save 3% of their lifetime income. So over their whole lives, everything they earn, their savings amount to 3% of that. Those in the richest quintile save 25% of their lifetime income. And the richer you get, the more your savings is. Sort of, you just can't, Elon Musk just can't spend the money, okay, fast enough. By definition, your savings can be very high the richer you get, okay? So basically, in the top 1% of the income distribution, those people save roughly half their lifetime income. Well, changing to this tax system, while from the perspective of that table it looks fair, remember we've got to think about the transitional impact. We're going to move to a much more regressive tax system. This is essentially a huge tax break for the rich. Because basically they're the savers and the system favors savers relative to the existing system. It's neutral relative to no taxation, but relative to today's system, it favors savers. Okay? Now you might say, look, you might say, well, look, there's a couple ways we could deal with this. First of all, the rich save the money. What happens to it? Well, eventually they just leave it to their kids. So if you had a consumption tax that included estates as a form of consumption, that would solve the problem. So you said, in your consumption, I'm include what you leave behind. Well, then they wouldn't escape the tax. Wouldn't matter if they save more, they'd eventually get caught. The problem is, we already have a huge fight over a tiny estate tax. And indeed, there's an article about this. I wish it came right before I taught the lecture. It's a New York Times article just yesterday, maybe 2 days ago, about noting that the wealth of the richest Americans has gone up 4 times in the last 30. It's gone up 4-fold in the last 30 years. But estate tax revenues have stayed flat, because we've increased we increased so much the exemptions and people are taking more advantage of the loopholes. So the notion that we're going to suddenly put in we're going to massively tax every dollar in every estate is insane. That's not going to happen. So we could get rid of that. We're not going to. Yeah.
Sorry, what was the thing that has gone up?
The amount of wealth the richest are holding has gone up, but they're not paying any more in estate taxes.
The absolute amount of the rate hasn't changed?
The absolute amount.
Oh, wow.
So that's one way. Another way you could do is say, well, look, we could have a progressive consumption tax. We could basically say, look, instead of having a sales tax, a sales tax by definition can't be progressive. You can't walk in, I can't say, that's a nice suit, I'm going to charge you more for your cookies. It's not going to work. But you could say, what instead of a sales tax, we had an expenditure tax. The way the expenditure tax would work is literally I'd add up what you spend all year, and I would apply a progressive tax schedule to that, just like I do to income. The problem is, it's impossible. Because if you think tracking income is hard, tracking spending is a nightmare. Okay? There's no way that we can actually, and countries that have tried, it's absolutely failed. No one's ever been able to successfully implement an expenditure tax. Yeah?
Is there any behavioral studies or impact of are there any
Oh, yeah, it does what you think it does. It lowers consumption, increases savings, absolutely. So that's one argument against it. There's actually a subtle version of this vertical equity argument, which is sort of a targeting argument. Remember when we talked about welfare? We talked about how a good welfare system might find who really needs help and target them. Well, there's a similar issue in taxation, which is imagine a world where you know who's rich and poor, but you can't tell who's really needy and who's not. And some of the rich guys are actually sort of unskilled guys working incredibly hard. Some are guys who just are living off the fat of the land and happen to make a lot of extra money through their parents or whatever. You'd like to tax the latter and not the former. Well, you can't because they both have high income. But it turns out if being a saver is correlated with being a high underlying ability, with someone who underlying is going to be rich, you might want to use the amount you save as a way to tax people. You want to say, gee, you save a lot. That must mean you're a guy who really is rich. Let's come grab you and let's tax you. So it's sort of a targeting argument. It's a little subtle. The other major problem is the transition issue. OK, here's the question. Think about this for a minute. Come on, last few opportunities to answer questions. Let's go. Here we go. Think about this for a minute. Think about three groups of people: babies, 40-year-olds, and 70-year-olds. And imagine we're going to replace the existing income tax with an equal revenue consumption tax. Okay? Who wins and who loses? Let's start with who loses, because that's the easier one. Who loses when I'm going to say, look, starting tomorrow, I'm not going to tax your income, I'm just going to tax your consumption. But I'm going to have to raise the same amount of revenue. Who's the big loser in that? Yeah.
70-year-olds.
Because?
They are probably retired, make no income, but they still need.
They paid income tax their whole life, and now as they spend their money, they're going to hit again. They are totally screwed. Okay? Who benefits the most? Well, the babies. Because this consumption tax is going to increase the capital stock, raising wages in the long run. The 40-year-olds are kind of indifferent. Maybe 35-year-olds, I don't know what age you're indifferent. But the bottom line is this parallels a bit our discussion of Social Security. There's a bit of a legacy debt issue here when you switch from income to consumption taxes, which is that basically you have ended up screwing the people who paid income tax their whole life, and now are going to have to pay consumption tax as they draw their savings down. And that's going to be a very hard thing. That's going to be a very hard thing to deal with. Much like, and indeed, people have estimated models. You know, Enoch asked about the economic effects of consumption taxes. People have estimated models showing that consumption taxes increase efficiency. But if you have to bribe old people, imagine you have to say to old people, we're going to put the consumption tax in and we're going to grandfather you. We're going to make you not pay and just put that on extra debt. That would undo all the efficiency gains of moving to consumption tax. The consumption tax, a lot of the efficiency gains come from actually screwing the old people. And if you're not willing to do that, you're not going to get a lot of efficiency gains from switching to consumption tax. So that's the third problem. A fourth problem is, so you can't do an expenditure tax, you have to do a sales tax. Well, the fourth problem is compliance, which is basically when I earn income, okay, for most people that's recorded in ways the government tracks. But I can always buy stuff off the back of a van, the government has no idea. So it's actually, and imagine a world where there's 25% sales tax, which is what we'd be talking about to replace the income tax. There'd be a lot of incentive to buy stuff off the back of vans. And there'd be new apps that wouldn't be tracked by the government. Bitcoin would take off. Actually, the Bitcoin advocates should love this, right? Everyone's starting to start using Bitcoin to buy things the government couldn't track it and they never pay taxes. So compliance is a nightmare. And then finally, we have a more subtle problem, but a subtle problem that motivates the next step, which is what you can call the cascading problem. The cascading problem is that some consumption goods are intermediate inputs into other consumption goods. So think about the classic example of fruit basket. Well, imagine a fruit basket maker, where you buy the fruit, you put it in your basket, you buy the fruit, you buy the basket, you put them together, you sell it. Well, if you pay consumption taxes on the fruit and consumption taxes on the basket, and then you sell those consumption taxes on what you sell, that's double taxation. Now, if you have 3 levels of inputs, it's triple taxation. It explodes. So in a world where consumption taxes could be levied on inputs in theory, you have a problem. So these are the arguments against that. But these last two in particular have led to a particular form of consumption tax that's used around the world called the value-added tax, which any of you who've traveled to Europe, you've dealt with the value-added tax. Okay, the value-added tax. What is a value-added tax? A value-added tax is literally it's what it says. It is a tax, it's a cascading consumption tax where each level of production is taxed only on its value added. So let's look at an example. Imagine you're making a kitchen table, table 25.3. Not you're making kitchen table in table 25.3. Okay? Basically, you've got 3 stages. First, the logger cuts down the wood and sells to the manufacturer. The manufacturer makes the table and sells it to retailer. The retailer sells the table to you. So the logger has no inputs and maybe buys an axe or whatever. But assume he has no inputs. He sells the wood for $25. So his value added is $25. The manufacturer buys the wood for $25, then sells the table to a retailer for $75. So his value added is $50. The retailer sells the table to you for $100. She paid $75 for it. So her value added is $25. So what we do is at each level, we tax people the value added. How does it actually work? It literally works that when the manufacturer has to produce the receipts for what they paid for their wood and the receipts for what they sold their tables for, and they're taxed on the difference. Okay? And what that means is if you want to raise $20, you could either have a 20% tax on a $100 table at the end of the day, or you could have a $5 tax on the loggers, $10 on the manufacturers, and $5 on the retailers. Now, either way, you raise $20, but there's 2 key advantages of value-added tax. The first is it gets rid of the cascading effect, because everyone's only taxed. You only tax on your value-added. So that fruit basket person would get to deduct from her taxes what she paid to get the fruit in the basket. She only taxed the value-added. Okay. The second advantage is that it helps with compliance. And why does it help with compliance? Why don't people just cheat like mad in this? Yeah.
Because instead of having, like, each person is faced with a smaller sort of tax hit along the way.
Smaller tax hit, that's one thing, and we know from the last thing that the smaller the tax rate, the less incentive to cheat. But it's better than that. There's another feature. This feature becomes self-enforcing. Why? Yeah.
Because if someone cheats before you, then you get screwed.
Yeah, exactly. If the logger claims he only sold it for $20, then the government says, wait a second, the logger says $25, but this table manufacturer saying he bought it for $25, something's going wrong. So it becomes self-enforcing. So if you're going to do it, basically this is a well-functioning consumption tax design. Okay? So that is one way you can do the consumption tax. Okay? Now, the U.S., there's actually another way you can get to consumption tax, which the U.S. is part of the way to getting there, which is what is consumption? Consumption is income minus savings. The U.S. taxes income. We can move to consumption tax in 2 ways. We could tax consumption, or we could let people deduct savings. If you deduct savings from their income, then you're taxing consumption. Well, guess what? We do a whole lot of that. We let them, we have low tax rates on capital income. We have savings, retirement accounts, etc. So actually, we are in between an income and consumption tax because we have a lot of tax breaks for savings that we covered in Chapter 22 and Chapter 23. Basically, the tax break for capital gains is an incentive to save. So we have lots of tax breaks for savings. So we're actually partway to a consumption tax in the U.S. And once again, you can now see the argument for why, which is, gee, by taxing income instead of consumption, we are reducing incentives to save. So we want to increase incentives to save by moving consumption tax. But the same arguments, the same vertical equity argument applies. Essentially, the fundamental trade-off here is between efficiency and equity. That basically it would probably be more efficient to have a value-added tax than an income tax. But it would be less equitable. And like many other things, for that reason, it's hard to imagine today that if the fairly liberal countries in Europe had an income tax, they'd be very eager to switch to a VAT. But since they had a VAT a long time ago, for a long time, they are able to do that. Yeah?
How do you reason about the macroeconomic benefits of, like, spending versus saving
So basically, it's confusing for you because you guys just lived through a big recession. As I said, this course runs in a full employment economy. In the long run, saving is productive because saving converts to capital. Now, we've lived through a period in the short run, when there's periods of insufficient demand, you want to spend. You want to encourage spending. But in the long run, you want to encourage savings because that builds the capital stock in the economy. So it's really sort of a short run, long run distinction, or sort of a full employment macro versus sort of cyclical macro. We talk about this in chapter 4. So basically, that is kind of the fundamental trade-off we face when we think about how do we deal with thinking about consumption versus income taxation. Other questions? Yeah, Enoch.
That was less equitable.
What's that?
You mentioned that like it was less equitable.
Less equitable than an income tax.
Than income tax.
Yes, not than other consumption tax. Less equitable than income tax. Absolutely. Other questions? Yeah.
How practically if we bundle that with UBI?
Well, that's a very interesting thing. So in Europe, this is actually a really fascinating contrast between the way taxation works in the US and Europe. Europe actually has much higher taxes on labor or consumption. Remember, in income tax, consumption tax operate in similar ways. They have much higher taxes on their average Joe, okay? And they actually have fairly low taxes on capital. So you might think, well, gee, we thought liberal was all Europe. Well, the difference is they raise extra money into a lot more pro-poor spending. Not a UBI, because they want to target the poor. But the idea is, and in some sense, this is quite interesting. Actually, great question. This is why Andrew Yang was off his rocker. Okay, sorry for all you Yang fans out here. That's 2020 election going back. But Yang wanted to move to a consumption tax to fund a UBI. Think about that for a second. We have a current income tax, which is progressive. He wants to move to a flat consumption tax and then give money to everybody, including the rich guys. Okay? That doesn't help progressivity at all. That massively hurts progressivity. You're essentially in a progressive income tax system to a flat system where you're giving everybody the same amount of money. Now, a consumption tax that funded a basic demo grant where everybody got $20,000, that could be equitable. So that's basically what Europe does. What Europe does is they have a consumption tax that funds very progressive spending. But a consumption tax that funds a UBI is we're just going to move from a system that's progressive to a flat system. Everybody pays the same tax, everybody gets the same money. The rich are in the same place as the poor. That doesn't do us any, that hurts. Does that make sense? Sorry for you Yang fans out there, yeah. What's that? A basic demo grant, which is just a flat amount of money to I'm sorry, let me back up. I said it wrong. Amount of money that's targeted to the poor. I didn't mean a demo grant. A basic amount of money that's targeted to the poor. So in other words, think about something where you say, well, consumption tax, and basically we're going to take everyone below this level of consumption and give them an extra $20,000. Or alternatively, what Europe does is not that. They say we're going to have a high taxation, and we're going to have universal health care that's going to mostly help the poor. And you might say it's universal. Why isn't universal health care like universal basic income? Well, going back to healthcare chapters, universal health care in Europe is not the same as universal basic income for a simple reason, which is that the health care is mediocre. So the rich guys have to buy extra. Essentially, it is not truly universal. It's basically better for poor guys, and the rich guys buy extra. But what Europe does basically is set up a more redistributional welfare state funded by higher taxes. And it's not clear which way we feel about that. It's not, it's a very interesting contrast in how they do it. Other questions? Yeah?
That term, demi-grant,
That's UBI. I used the wrong term. Yeah?
So does consumption have a much lower variance than income? Meaning do the rich guys
Great question.
the most that sorry, I don't know how to.
No, you actually asked a great question. I didn't cover this. I covered this in chapter 19 in the book. So when we talk about progressivity, I think I'll answer your question. Let's see. We talk about progressivity, we talk about it in terms of current income. But current income is not a good measure, in many cases, of lifetime income. So for example, you are currently very poor. You will eventually all be well off, I predict. Okay? So it's not really, so if I say right now you got the same income as some guy working at a gas station, well, lifetime you're going to have way higher income than some guy working at the gas station. But I'm taxing you on your income now. Consumption under the life cycle model is a representation of my lifetime income. So under a life cycle model with borrowing, you should be borrowing right now and consuming more. Now, you're not fully, but you're probably consuming more than you would if you knew this was your permanent income. If you knew forever this was going to be your income, you probably wouldn't consume what you're consuming today. Okay? So the point is, that's why people said when we think about tax fairness, the right measure is not income, it's consumption. And in fact, if you use consumption, the tax system appears much less progressive than if you use income. And basically, because a lot of the low-income people are actually going to end up rich. So we're actually taxing them. We're actually going to end up taxing rich people too low. The rich people won't end up being poor, but some of the poor people could end up being rich. And so basically, is that sort of what you're getting at?
That was interesting, but I guess, wait.
Okay, I'm good. I'm done. Next? No, go ahead.
Well, that was like part of the question. But another part was like, so like the poorest people versus the richest people, like there's a huge gap in what they make. But I'm wondering if the gap in what they spend, like if people
Right.
kind of.
Yeah, and why does that matter?
I was wondering because if we do tax consumption in a flat way, then that is less equitable. If people kind of, like if people's consumption like converges to a mean, or not a mean, but like something kind
In other words, if you're saying in some sense, but equity is about signaling who really needs help and who doesn't. You're saying consumption is a worse signal, in some sense, of who's really truly needs help.
maybe, yeah.
Yeah.
Because there's like certain like necessary.
Yeah, no, exactly. You're saying that like if we tax consumption, in some sense we're going to tax, even if you're really poor, you're going to have some level of consumption. So we're going to, yes, that's a great point, that basically we're going to end up, it's in some sense a less, essentially your point and my point bound the truth. So my point is consumption is a good measure because it represents your lifetime resources. Your point is consumption is a bad measure because if you got to consume a certain amount. The truth depends on to what extent the life cycle model explains reality. If people really behave by the life cycle model perfectly, then consumption is the right measure. But if they don't, and they basically have to spend extra just to survive, and it's money they are never actually going to have, they're going to be in debt the rest of their lives, and never pay it off, then that's a problem with consumption taxation. Does that make sense?
Yeah. Thank you.
Okay. So that's consumption taxation. Now there's another approach, which is just to say, well, look, let's just keep the income tax system, but go to a flat tax. And this was all, the very popular proposal like Herman Keynes and others, was basically a flat tax. And so here's, for example, a way, the most famous economist flat tax example is the Hall-Rabushka tax. Here's how they set it. Here's how they set it up. It's actually pretty interesting. It's not a flat tax, but it's sort of a simpler tax. Basically, they say all corporations, all businesses pay a VAT, but they deduct the wages they pay. So it's a VAT with an extra deduction. You deduct the wages you pay. Okay? Individuals then pay taxes just on their wages. Okay? And capital income is exempted. All capital income is exempted from taxes. Okay? So basically, this is like a VAT. So why not just use a VAT? The difference is that a VAT can't be progressive, but this can be progressive. So we take wages out of the VAT, but then we have a progressive tax schedule on wages. And that way is a way of introducing progressivity into a consumption tax system. Then the question is, well, how much progressivity do you want to introduce, and how flat should the tax rate be? And basically, the answer is you can raise a lot of money. The other thing they would do is beyond this, all loopholes are gone. Health insurance deductions gone, everything's gone, child reduction, all loopholes are gone. So you have a huge tax base. It's the broadest possible tax base. And it turns out you can then raise a lot of money with a fairly low rate. The problem is that low rate leads to a lot of change in progressivity. So for example, here's a flat tax. Here's an example of a Hall-Rabushka tax. Okay, it's just for certain parameters. It's just, you can design it any way you want. This is just to give you an example of a flat tax. Where basically what you see is tax rates rise for those who are more towards the bottom distribution because you have a flatter tax, you're raising the bottom rate. And they fall a lot for those at the top of the distribution. You raise the same amount of money, but basically it ends up a flatter tax rate system it's going to have less progressivity. And the Tax Reform Act of '86, let's be clear, the richest people only paid twice as high a rate as the poorest people. Whereas today, the richest people pay a rate that's about 4 times. So the top rate's almost 4 times the bottom rate. Tax Reform Act of '86, the top rate was only twice the bottom rate. Now, there are people who don't pay tax at all. They're always exempted. But among taxpayers, if you followed my advice and got rid of today's system with the Tax Reform Act of '86, people are like, wait a second. You've gone from a bottom rate of 10 and a top rate of 40 to bottom rate of 15 and a top rate of 33. How is that fair? Yeah.
How has the ratio of like effective tax rate between the poorest and richest people changed over time, rather than just what's on the schedules?
Under this system?
Like,
Right. Oh, have they?
like historically.
Oh, that's Chapter 19. We showed that. We showed that. Those are in the tables in Chapter 19. Basically, what's happened over time is poor people have paid less tax as a percent of their income. Rich people have paid about the same amount, or a somewhat rising share of their income in taxes. Not rising as much as inequality's risen. But actually, it's interesting. We say the rich get tax breaks. Well, the truth is the share of income the rich pay in tax has actually gone up over time. But critically, let me back off on that, that depends on how you treat unrealized capital gains. If, like I talked about the other day, you treat unrealized capital gains as income, then the rich pay much, much lower taxes. Right? But that's sort of a controversial topic. Is should we think about this? Because it's not actually income. They didn't realize it. And how should we think about that? So basically, the progress of the tax system depends a lot on how you think about unrealized capital gains.
Sure. So I guess maybe the same question based off of the flow of wealth rather than income per se.
Yeah. Then basically, I mean, I don't know the full distribution, but the tax rates in the rich are, I don't know if they're lower than the poor, but for many rich people they are. For the wealthiest people they are. So basically you get this strange inversion then. Because the super wealthy are the ones with huge unrealized capital gains. So basically I don't know how much it would change $25,000 versus $200,000 incomes, but the billionaires get a huge break. So basically, where does this leave us? Well, this leaves a situation where the tax section ends up a bit where the redistribution section ended up with our fundamental equity efficiency trade-off, that we can design a more efficient tax system if it's flatter. A flatter system would be more efficient. It would help with compliance. It would help with simplicity. But you would have vertical equity concerns. So it seems to me, now my editorializing, it seems to me the best of the both worlds is have the flat tax base and just have a steeper schedule. Basically, in some sense, there's 2 steps. There's the base and the rates. The holes we've put in the tax base are a major source of inefficiency. In fact, there's one of my favorite economic studies re-estimated this taxable income elasticity at different kinds of tax bases. The US, the tax bases changed over time. And they found the more comprehensive was the tax base, the lower was that elasticity. Why? Because there's less loopholes to take advantage of. So in some sense, this is the tau squared effect on steroids. That basically, the more that not the tau squared, I mean, it's the whole deadweight loss debate on steroids. We talked about how higher tax rates can cause deadweight loss, and in particular among high income payers. But the deadweight loss itself is a function of the base. It's not exogenous. The more comprehensive is the base, the less deadweight loss from taxation. Because much of that deadweight loss comes from fucking around with trying to get different holes in the base. That's gone. So it's actually a fascinating interaction. The taxes, when you broaden the base, you not only raise more money, you make taxes more efficient to collect. So it's an extra boost to the Haig-Simons argument. The Haig-Simons argument was, this is the way I want to say it. The Haig-Simons, you remember our deadweight loss formula was a function of elasticities and tau squared. The Haig-Simons argument was all about tau squared. But there's actually an elasticities part of the Haig-Simons argument, which is when the base becomes more comprehensive, you not only get to lower the rates, lowering the tau squared effect, but you lower the deadweight loss of taxation, lowering the elasticity effect. So a broader base has a double whammy in terms of tax efficiency. So basically, what we should do is move back to the Tax Reform Act of '86 base. I would advocate somewhat more progressive rates, but that's then just a social debate about, we can just have a social debate about the inefficiency of higher rates versus the social redistribution. But once we get the base off the table, there's not that much inefficiency from progressive taxes. And that, I think, is the key thing. Does that make sense? That's the key thing to realize, that the inefficiency of taxation depends on how you define the base being taxed. Okay? Okay. Well, let me then wrap up with a couple of final points I want to cover. The first point is, and the most important point is, what I want you to take away from this course. Okay? Now, if I took anyone in this class convinced I'm going to PhD in economics, that's a bonus. But the main thing I want you to take away from this course is just how to be intelligent consumers of information about government policy. Okay? I don't expect you to remember. The only thing I expect you to remember is the difference between Medicare and Medicaid. Other than that, you can forget the rest. I just want you to remember, when you read an article about this wonderful sliding tax break, to think, wait a second, is that a good idea or not? That depends on how much money you're going to spend versus how much of the behavior you're going to encourage. When you read something about a new social insurance program, to think, well, what's the benefit of that, and what's it going to do in terms of inducing bad moral hazard? When you hear something about the environment, think about, is that the best way to try to accomplish this environmental goal? So just be smart consumers and go out there. We are in a period of time of sort of the lowest respect for expertise of my lifetime. Okay? This is just, we have a crisis of expertise. And part of the problem is due to a place like MIT. And why is it due to MIT? Because we don't talk in ways that people can understand. We talk to each other through very erudite articles, and we don't explain to people clearly how to think about these problems in a non-judgmental, non-dismissive, clearly understandable way. I've given you the tools to do that here. Okay? So now go out and do it. In the real world, make sure when you're encountering people in the real world and they're thinking about these issues, that you help them understand the right way to think about it. Once again, in a non-paternalistic way, but in a way which puts these tools to use. Okay? So that's the main thing I want to get out. The last thing I'd like to end with, and I apologize for how many people took 1401 with me? I know Enoch did. Okay, I apologize for the same joke again, but others who didn't hear the joke. It's my favorite economics joke of all time. So my favorite economics joke of all time, which is about the doctor, priest, and the economist to go golfing. They're on the golf course. They get in the golf course, and there's someone ahead of them, one person playing alone, who's going unbelievably slow. They are taking like 25 shots for every hole. And I'm not a golfer, but apparently good etiquette in golf is if you're very slow and there's people behind you, you're supposed to let them play through. You get ahead of you. And the golfer wouldn't do it. And so there was lines of like 20 people waiting behind this person, taking forever. Finally, after 9 holes, they quit. They go to the clubhouse. They're pounding their beers. They're really upset. And they're like, God, what an asshole. I can't believe let's play through. And someone comes up and says, well, excuse me, are you new at this club? And they said, yes, we are. I said, well, I know you're new, because if you weren't new, you'd understand the person you're playing behind is blind. And actually, the reason they take so long is because they're blind. And actually, it's pretty amazing they'd make it at all. That's pretty incredible. So, you might want to think about that. And they walk off, and there's a dead silence. And the doctor goes, oh, my God, I can't believe that, I said such a mean thing about a blind person. My whole job is to help sick people, and here I am insulting blind people. I'm going to dedicate a wing of my hospital to the blind. And the priest goes well, what about me? I'm supposed to be like this holy man who takes care of people, and I'm insulting this blind person. I'm going to set up a free soup kitchen for the blind. And they go to the economist, and the economist says, well, if he's blind, why doesn't he golf at night? And I love that joke. That could, of course, be told about any engineering field, right? I love that joke because it shows our roles to be a pain in the ass. Okay? A well-communicated, non-paternalistic, effective pain in the ass. Okay, and that's what I hope I trained you in here, and you'll learn in 1401, you'll learn economics at MIT, is how to be a pain in the ass, and how to basically live up to our title, The Dismal Science, in a way which actually makes the world a better place. Okay, so I'll stop there. Good luck on your exam, and I hope to see all of you more. Remember, like I said, I'm still around in the spring, so feel free to stop by. Thanks.